The price of oil has really been leading the markets. Part of it is as a result of concerns about the long term economic impact around the world of the coronavirus. And the other part of it is brought about by the price war that has been established between the Saudi Arabians and the Russians when it comes to what they're doing in terms of oil production. Let's catch up now with the technical viewpoint on the price of oil, and we're with Ron William from RW Advisory. Ron, it's good to be able to catch up with you on this subject. As I said, it's attracting a lot of column inches in the newspapers at the moment, and it's hitting the main news headlines. So we're talking about something that is really in mainstream media now at the moment. What's your thesis around the price of oil and, as I said, the technical setup?
Well, certainly it's one of those times where black gold has triggered a black swan event. And last time we spoke, it was all about this whole definition and real-time experience of the 2020 black swan phenomena. And of course, we kicked off this year with the coronavirus pandemic situation, which led to the shutdown. And that very much is driving the demand side of the demand-supply equation for oil, which has been a double negative, really, for the market. But looking at the chart, what we can see is a potential negative new normal based upon a new regime that we've entered.
Okay, so you've got the this new normal. Just explain the lines here, the sloping lines on the right-hand side of the chart.
So the sloping lines are basically trend regression bands worth 1 decade or more, all the way back from the 2008 super cycle peak. Back then, we were at $147.27 on oil, and many market pundits were talking about peak oil. If you recall back to those days, certainly we've gone the opposite way. And the old normal had a plus or minus 1 standard deviation from a mean which roughly ended up around $50. That was the old equilibrium. The new equilibrium is actually closer to minus $30. And there are some other levels I put in and around that minus 30 level. One key level that I would highlight to many people is if you look at the 1998 low, which is a wave 4 of a impulsive long-term pattern, that's at $10.35. That will be a very important strategic level on oil. And then add on to that the statistical levels, which I've highlighted there at $20 and $30. These are the higher upside pressure points for oil based on the historical price action. Now, of course, the year high was $65.65, and the low, as we all know, minus 40 and 32. And that's likely to be a multi-month low, if not a resilient one to break below. We're probably not going to break below that anytime too soon.
Okay, let's take a look at the short-term picture now, because I think this gives us some more feel for what we've been experiencing in the last few weeks or so. So bringing up your second chart, you've got here the oil short-term tactical setup.
Yes, so many people are trading this right now, especially on the short term. There are people trying to make money on both sides, short and long side. So it's really important that we do also zoom in on the trading opportunities. And what we see there is that big cliff drop from 65, the high for this year, into minus below zero territory at the minus $40.32 mark. Now, the key levels there are basically minus $5.30. That's the 1/3 retracement of the year-to-date fall. 0, which is actually the Fibonacci 38.2% retracement, still significant even if we are in negative territory. And then higher above those, technical levels at $25 and $29.50, which is the Fibonacci area of 61.8%, and then just the psychological or Dow theory component, 2/3, 66% of the year-to-date fall. Now, I know I'm throwing out a bunch of numbers here, but we must remember that these are psychological and mathematical numbers that do work in positive or negative scale territory. And so it will still be important, particularly to the short-term traders. And just a final word on the price distribution indicator on the left there, and that is statistically driven. The levels there are 2380 as the big value zone on the short-term level, 1350 down below, and then various other levels underneath that. For those who want to look at just basic trend filters, they still work, but of course, they will lag in fast-moving markets like the one that we're in. The 200-day moving average is at 49.30, 50-day moving average at 28.53, and for trading purposes, I still tend to use the 8 and 20 exponential average.
And when we talk about the price here and this negative pricing, this was just one contract, wasn't it, at the time? We're waiting to see whether or not we get another negative reading for the next futures contract, which is coming in, to be the June contract. So let's just establish here, we're talking about the futures market, aren't we?
Yes, so tomorrow's price is today, based on the futures market expectations. And so for anyone who deals in the futures market knows this very well. And for traders who may be new to this, you need to be studying the futures pricing to get an idea on if what happened in May will happen again, but also just the level of volatility and just general price trend expectations. Now, the final word on the futures contracts is that contagion and contango is still here for the foreseeable summer months. So here we can see on the chart the contract for June delivery, July delivery, August and September, all pointing down. So this is a kind of a silent contagion effect leading to further contango and potential negative pricing to come. So there is further downside pressure on oil across the contracts. Now, of course, people who want to hedge that risk will potentially look out further down the time duration curve in order to try and lock in some stability on the oil market.
Let me just step back and educate those that perhaps maybe not have come across these phrases before, contango and backwardation. This is all about when the spot price and the futures price are doing different things, isn't it? And whether or not the futures price is higher or lower than the current spot price. In this new normal setup, are you suggesting that contango, when we have the futures contract continually lower than the spot price, you saying that is part of the new normal?
Yes. So thank you for clarifying. Of course, it's terminology that can be new for many people. And yes, contango and backwardation is a dislocation or imbalance between actual prices and future prices. And so traditionally, there's an equilibrium between the two, or if there is a difference, it gets arbitraged soon in. The issue is now, as we're in negative territory, this imbalance is that much more of a black swan event. And so for that reason, we're all really paying a lot more attention than back in the day when this would be a short-term arbitrage opportunity. So to answer your question, will this negative contango effect continue where future prices are lower than current prices? Yes, I believe that pressure will continue. And that's what we're seeing here on the various line charts pointing down. These are future contract expectations of current price action in oil. And so that contango is being signaled by these lines pointing down across the summer contract months. And I'll just repeat, June, July, August, and September. This isn't just a 1 to 2 month affair. This is likely to continue for several months ahead.
Yep. Okay, let's move on and take a look at other aspects of the oil market that this is having an effect on. What about the ETF market?
So, I mean, it's really a once in a lifetime opportunity to either make money or manage risk. And certainly the actioning of those trade strategies is going to be key. And so the last two charts are focusing exactly on that. How do we trade this? Now, one of the most popular ways is to do it via an ETF proxy. And this is a mixed blessing in my perspective, and I'll explain why. On the one side, it gives exposure to the oil market. And if you look at the blue line, that's the composite of 24 oil ETF funds, all pointing up. You can see that it's a big spike into a 5-year ceiling. So we're really at record territory in terms of demand for ETF oil trading. A proxy of ETF oil trading, of course, is and a very popular way of doing that is through the United States Oil Fund, USO. Many people will know and maybe trade that fund, and that's also mirroring the same positive demand for ETF oil exposure. Here's the issue. Rewind back to 2018, when we saw a similar retail wave in these speculative trends where money got a little bit too hot. And you might remember in the volatility market space that these things don't last forever and there is no free lunch. So while it is a good trade opportunity at the moment, we must be aware that on the other side of this long trade where people are trying to pick the bottom in oil, there are oil suppliers out there that will literally try and hedge their precarious position by selling back to the buyers that are just trying to speculate. This might create an ongoing imbalance, and in some cases where some of these ETFs actually will have unstable futures. We've already had reports of 1 or 2 oil ETFs that literally closed for business. So I would say make money in the ETF business on oil where possible, but be selective and be very risk prone to what happened in 2018 when we had similar speculative hot money interest in the volatility market. Let's learn from that lesson.
It's interesting looking at some of the trade setups around the price of oil. I know as well as we've been following what's been happening with some of the commodity currencies, the Australian dollar, the Canadian dollar. I know also you've got an interest with a chart here for the Norwegian kroner. How are you setting up that as a trading opportunity around the price of oil?
Yes, so for those existing currency traders, why not build on your existing strengths and just maybe take some trade exposure opportunities in the currency world, especially because of those kind of deep, rich liquidity markets. You can trust at least some of the viability of the currency moves. And so Norwegian kroner is such a currency that you can take out the pick in terms of energy-related proxies. And you can see the Norwegian kroner inverted against the dollar, hence the negative prices, with oil in red. So you can see they're clearly correlated and both affected at roughly the same time and magnitude. We are in a rebound territory now, and so out of the Norwegian kroner complex, if you look at some of the other currency proxies, Norwegian kroner against the pound and against Swedish kroner are the leading outperformers on the short-term recovery from the cliff drop, which has been induced by both oil prices, but of course the global pandemic lockdown that we're in.
So just to clarify, the weakness that's been seen for the Norwegian kroner, the rebound that we've seen, if we do get a new normal with these futures markets showing regular negative pricing, that presumably is going to put a lot of pressure, though, on the Norwegian kroner and, as I said, also those other commodity currencies.
Yes, absolutely. And that might become the new normal. Remember, what we're hearing from the pandemic experts is that it'll be maybe 1 step forward and 2 steps back in this kind of rollout back to a normal, and certainly a new normal, not the old one. And so technically what that means is more volatility, potentially further negative regime on the oil market, or at least mean reverting in and around that zero mark. Which is part of that regression trend analysis I showed you on the first chart. And specifically on the Norwegian kroner, if we flip it around in tradable numbers, so dollar versus Norwegian kroner, the key levels are 1039.60, 998, 999.80, and then 983.30. These are the key retracement levels on dollar versus Norwegian kroner for those who want to trade it in that direction.
Okay, look, Ron, it's been a pleasure. Thanks indeed for giving us your insight into oil and how to trade these oil markets in these times that are producing, as you say, a new normal. That's Ron William from RW Advisory. If you want to catch up with Ron, you can do so through his website, rwadvisory.com.